Hey YouTube, in this video we'll be programming some historical experiments on the past 100 years of the stock market to see how different strategies compare over the long run. Don't worry if you can't code, this video will be mostly non-technical, but for those who want to dive right in, I'll be putting the source code in the description. So, my motivation for this video is basically the one-liners that you hear if you've spent any time in the market. You know what I mean, things like diversify your portfolio, reinvest your dividends, don't make emotional trades, and most importantly, the topic we're going to cover in this video. Never buy at an all-time high. Is this good advice? I mean, to maximize profit, you'd obviously want to buy as low as possible and sell as high as possible. So this must imply that the worst thing you could do would be to sell near an all-time low or buy near an all-time high, right? So you might be surprised to find it's not that simple. So this is the log scales chart of the past 100 years of the Dow Jones Industrial Average, which is the oldest and still agreed upon by most as the best indicator of the stock market as a whole. I've written a program to simulate 7 basic trading strategies to see how they would have performed over the past 100 years. And the results might surprise you. So, imagine our 7 investors. We'll use one of them as a control group for comparison's sake, and the other 6 are going to have very specific methods by which they'll trade. But all 6 of them are going to follow this rule. They will not buy at an all-time high. All 6 will also listen to this statement. They will buy at relative lows, but at varying extremes. But just 3 of the 6 will follow this final rule. So 3 are going to have a buy and hold type mentality, while the other 3 will aim to lock in profits by selling at an all-time high. Okay, so let's meet our investors. All of them will have the same income of $1 per year for the past 100 years. Our control investor will be the simplest. Every time they get $1, they immediately invest it in the Dow Jones. It doesn't matter if it's the height of 1929 or the bottom of 1932. As soon as they get their yearly dollar, they invest it unconditionally and never sell. Now, let's meet the first experimental investor. This investor will take a gradual buy and hold approach. So basically, if the market is at a relative low, they will invest a single dollar. But if the market is at an all-time high, they will simply hold their income dollar in the bank and wait for another opportunity. They will never sell. Our second investor will be pretty similar to the first, but will take a slightly more aggressive approach. Every year, they will put their dollar in the bank and invest half the money in their bank if the market is at a relative low. Otherwise, they will let their bank accumulate for the next opportunity. They also will never sell. Now, the third investor will be the most extreme. They'll be very similar to the green investor, but instead of investing half of their bank, they'll invest all of it at the opportunity of the market being at a relative low. The green investor will perform better during long recessions, where they save some capital to invest when the market goes lower. But the blue investor will do better during short recessions, where they can take large positions when the market experiences a hiccup. All 3 of these investors will never sell. Now, our final 3 investors will be very similar to the first 3. The only difference is that they are willing to sell when the market reaches an all-time high in an attempt to lock in profits. For example, the orange investor will buy $1 worth of the Dow Jones when the market is at a relative low and will sell $1 worth of the Dow Jones when the market is at an all-time high. The pink investor will spend half their bank on the Dow Jones at a relative low and sell half their position at an all-time high. The yellow investor will do the same, but with all of their cash and all of their position instead of just half. Alright, so now that we understand the strategies of our investors, let's see how they would have performed over the past 100 years using 100 data points of the average closing price of the Dow Jones. Our first investor would have a total worth of about $6,300. Yes, that's right, only a single dollar payout each year over 100 years would result in that much money using the strategy of our first investor. But it gets even better from there. The more aggressive approach seems to perform even better, resulting in a total worth of $7,600 for the second investor. This makes sense, as the gradual investor doesn't really take full advantage of the lows that are produced by recessions. However, this backfires very slightly for the third investor, who took this a little too far and probably didn't have adequate funds for the times when the market kept falling. Nonetheless, all 3 of our buy and hold investors seem to have performed reasonably well. Unfortunately, I can't say the same about the remaining 3. The fourth investor has the worst performance so far, leaving them with just over $5,000. Things could still be much worse though. This number is at least comparable to the first 3 investors, mostly due to the fact that this investor was restricted to selling only $1 worth of the Dow Jones at a time. The final 2 investors did not have this restriction, and you'll be able to see that the damage is far worse. The final 2 investors come in far below $1,000, and even a full order of magnitude behind the top performing investors with the exact same income. The biggest issue for these investors is the fact that they were far too soon to cash out when the market was doing well, and had little or no position left when they really needed it most. In the most extreme case, our sixth investor is barely able to multiply their money by 5 over the entire 100-year period. But of course, the natural question to ask is, how do any of these numbers compare to the control group, which simply invested every dollar without even looking at the price chart? Well, here's the answer. The control group does better than all 6 investors, ending up with a worth of north of $7,700 over the 100-year period. Keep in mind, this is the only investor willing to buy in when the market is at an all-time high. Now, how could that possibly be the case? Wouldn't you expect that the market trading at an all-time high would naturally signal that it's inflated and due for a recession? So what you'll find is that historically, this is not the case. If you categorize the past 100 years of the stock market into one of these 4 categories, you'll notice an interesting breakdown, which helps to explain the main problem with our 6 investors. They're far too concerned with the past and not concerned enough with the future. Just because something is at an all-time high from the perspective of the past does not mean that it will not be a future all-time low. And the math makes it obvious that this is the case. When the market was at an all-time high, which was the case for about 40 years, 21 of them were also years the market was at a future all-time low. Which means that if you ever saw the market at an all-time high in the past 100 years, there'd be a 52.5% chance that it would never get that low again. Think about that for a second. Conversely, for the 60 years that the market was at a relative low, 29 ended up being a future all-time low. So anytime the market was at a relative low in the past 100 years, there'd be just a 48.3% chance that it would never get that low again. As counterintuitive as it might seem, the market being at an all-time high is a more reliable buying signal than the market at a relative low. So let's have another look at the price chart now that we've completed the experiment. If you look at the major market events like 1929 or 2008, buying in when the market falls maybe 10 or 20% might feel like you're buying in at a low, but really you're buying in at the worst time possible and the market has much further to fall. On the other hand, if you look at the 80s and 90s, the Dow Jones went from 1,000 to 10,000 in less than 2 decades, and every single dollar into all-time high territory probably felt like a tempting time to sell, although it would have been a mistake for almost all of those times. The key is market health. The public will only push the market to new highs if they believe it is healthy enough to warrant it, and the public will only sell a failing market if they believe it has further to fall. So this isn't meant to be a technical video, but I figured I would at least summarize the code just so you can see what's going on. It's 3 files, and if you want to run it, you just do Python on main.py, collects the data, and spits out all the numbers that we talked about previously in the video. You will notice some of them are very slightly different from the numbers you saw earlier in the video, and that's just because this data is live. So if you run it, a day or 2 days later, you're going to see slightly different numbers because now you're looking at a slightly shifted forward version of the data. So once again, you could run this in like 10 years, and the numbers would probably be pretty different, except the comparison between the numbers would be essentially the same, since that doesn't change very much over 100 years. So yeah, this file just calls all the different strategies. Strategies.py has a function that is representative of each of our investors. Probably not the most efficient code in the world, but you get the idea. And then this bottom function here will spit out data about that last part we talked about of past highs versus future lows. And then the bottom file here, where all the data comes from, is just a web scraper. I recently made a video about web scraping, so I'm not going to go into this too in depth, but I'll post a link to that video in the description if you're interested in Python web scraping. So the strategies and market data I presented in this video were obviously pretty simple and not very elegant, but I hope you could see how the ability to run market experiments on historical data could serve you well, especially if you have an idea that you're looking to prove or refute. So if you enjoyed the video, remember to like, comment, and share, especially if you have a friend who never buys at market highs, because maybe you'll change their mind. If you thought this video was helpful, consider subscribing because I'll probably make more videos like this in the future. Thanks for watching.